Ever wondered how governments fund massive infrastructure projects or how companies raise millions without giving up ownership? They borrow from investors like you, and the tool they use is bonds. Bonds might not grab headlines like stocks do, but they are one of the most reliable ways to generate steady income while balancing risk in your portfolio. The catch? Not all bonds work the same way. Some are backed by stable governments, others by growing companies. Some have collateral behind them, others don't. In this video, we will break down what bonds are, the main types and the risks involved. We will also show you examples that illustrate how different bonds behave, helping you to make confident decisions when adding bonds to your portfolio. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research or consult a financial advisor before making investment decisions. A bond is a debt instrument, which means it's a financial contract where one party borrows money and agrees to pay it back with interest. Here is how it works. When you buy a bond, you become the lender. The issuer, a government, company, or other entity, borrows from you. They pay you interest, called coupon, and return your investment amount, called principal, when the bond matures. Here is an example. You buy a government bond worth 5,000 euros with a 3% annual coupon that matures in 10 years. Every year for 10 years, you receive 150 euros in interest. After 10 years, you get back your 5,000 euros and the total interest earned is 1,500 euros. What makes bonds attractive is their predictability. You know upfront how much you will earn and when payments arrive. That's why investors use them for steady income or to protect capital when markets get volatile. Predictable doesn't mean risk-free. The issuer's financial health can change. Market interests can shift. Both affect your bond's worth, especially if you want to sell it before maturity. First, why do governments and companies issue bonds at all? Governments issue bonds to fund public projects like infrastructure, healthcare, or education. Instead of raising taxes immediately, they borrow from investors and pay it back over time. Companies issue bonds to raise capital for growth. Maybe they're expanding operations, building a new factory, or funding research. Bonds let them access large amounts of money without giving up ownership like they would do with stocks. So what are the key differences? Governments, especially stable ones, have the power to tax and control currencies. That backing makes their bond lower risk. A 10-year German government bond might only pay 2% per year, but it's unlikely to lose your principal if you hold it to maturity. The German government isn't going anywhere. Corporate bonds, they are only as solid as the company issuing them. A well-established company might offer 6% because they are profitable and stable, but still riskier than a government. A startup offering 10% sounds tempting, but that high rate exists because there is a real risk that they could fail. If the company goes under, you might lose your entire investment. That's called default. During a market downturn, these differences become obvious. Government bonds tend to hold their value because governments keep functioning. Corporate bonds can drop if investors worry about the company's ability to survive or make payments. So the trade-off is simple. Lower risk and lower returns with governments. Higher potential returns but higher risks with companies. Which one fits depends on what you're trying to achieve and how much risk you're willing to take. But there is another layer to bond risk. What happens if things go wrong? Secured versus unsecured bonds. Secured bonds have a collateral. A company might pledge a factory, equipment, or property. If they default, you have a claim on those assets. You're not the first in line to get paid, but you have something tangible backing your investment. Unsecured bonds have no collateral. Your repayment depends entirely on the issuer's ability to pay. If they fail, you're relying on whatever's left after secured creditors get paid, which might be nothing. The upside? Unsecured bonds typically pay higher interest to compensate for that risk. Bonds aren't risk-free. The three main risks are credit risk, interest rate risk, and liquidity risk. Credit risk is the chance the issuer fails to pay you back. Corporate and unsecured bonds carry the most credit risk. If a company defaults halfway through, you could lose both future interest and part of your principal. Interest rate risk affects your bond's market value. When rates rise, your bond is worth less because new bonds pay better rates. When rates fall, your bond becomes more valuable. This matters most if you want to sell before maturity. Liquidity risk is about how easily you can sell. If there aren't many buyers, you might have to accept a lower price just to exit, even if the issuer is financially sound. Before you buy a bond, ask yourself, can this issuer actually pay me back? What happens if I want to sell early? And how will interest rates develop? So now you know the basics, what bonds are, the main types, and the risk that comes with it. Government bonds offer stability but lower returns. Corporate bonds pay more but come with a credit risk. Secured bonds give you a collateral protection. Unsecured bonds rely on the issuer's financial health. And all bonds face interest rate and liquidity risk depending on when and how you want to exit. So what can you do next? Start by figuring out what you want to achieve with your bond investment. Is it steady income, capital preservation, or maybe a mix of both? This helps identifying suitable bonds for your portfolio. Looking for lower risk? Choose government bonds or secured corporate bonds. You want higher returns and are willing to take more risk? Then unsecured corporate bonds might be the right for you. Short-term bonds give you flexibility, while long-term bonds usually pay more but tie up your money for longer. Before you invest, check the issuer's financial health. Understand where interest rates are developing and how easy it will be to sell the bond if your plans change. If you're ready to explore bonds yourself, Mintos offers high-yield corporate bonds from just €50. You can automate with high-yield bond portfolio or select individual bonds and exit early through the secondary market if needed. Which type of bond are you most interested in? Drop a comment and let us know. If this video helped you understand bonds better, give it a like. And if you're ready to start building a portfolio that includes bonds, check out Mintos and see what fits your goals. Thanks for watching, and here's to smarter, more confident investing.